Qualifying for a mortgage always comes down to three parts: income, assets, and credit. So let's take a minute on each and break them all down and show you how we put a mortgage together and how you qualify. Let's start with income. What type of income do you have? How long have you had it? Let me give you an example. Let's say there's a husband and wife. Let's say the wife has an annual salary. That's the easiest to calculate, right? You make X amount per year, divide it by 12, your paycheck's always the same. You take a day off, your paycheck's the same. You call in sick, your paycheck's the same. Simple, okay? Let's say the spouse works hourly, makes so much per hour, and they typically work 40 hours a week. That's fine. If we can show it's always 40 hours a week, guaranteed, regardless if you're sick or a day off, then we count it as salary. But let's say sometimes 32 hours, sometimes 44 hours, sometimes, right, more or less. In that case, we have to calculate on an average. So to do that, we're going to need a couple of things from you. We're going to need your current pay stub so we can see how much money have you made so far this year. Plus, what's super helpful is if you can provide last year's pay stub, right? So at the end of the year. So in December, right, December 31st, you get a pay stub and it'll itemize all your income. Here's your base income. Here's your overtime income. Maybe you get a bonus, and it'll have a year-to-date number. That brings up the next point. We have to itemize each different type of pay to show that it's consistent and to show that you've received it for at least 2 years. Okay, so that breaks down income. Let's talk about the second category, assets. You need money for two things when buying a house. You need money for down payment. You need money for closing costs. Okay, so let's take 30 seconds on each. Down payment depends on what type of loan and how much you put down. Could be 0, could be 3.5, could be 5, 10, 20, right? There's all kinds of different percentages. Where does the money come from? Okay, we have some options. Let's rifle through them quickly. Option 1, it comes from you. You have it in your savings account. No problem. Show us a bank statement. We're good. Option 2, it can come as a gift. Someone in your family is the most common. They can gift you the money. If you go that route, talk to us first. It's better to give it straight to escrow. We can talk you through it. The third option, potentially, for example, in the state of Washington, has a very robust down payment assistance program. It could come from there as well. Okay, so those are three options to come up with your down payment. Let's talk about closing costs. Buyers and sellers each have closing costs. On average, 3, 4, 5% of the purchase price could be closing costs. It's usually not 5, usually closer to 3, but it depends if you're buying down the rate, right? There's lots of options. Where could it come from? Well, again, it could come from you. You have it saved up. Potentially, you could ask the seller to help. Talk to your realtor, case by case, but you could present an offer that says, I'm willing to buy your house. In exchange, I need you to cover some or all my closing costs. So it's a negotiable thing, okay? Hypothetically, and in real life, in practice, we've seen this where on one side, let's say the state covers your down payment through down payment assistance, and the seller covers your buyer's closing costs through seller concessions. Both sides are covered, so you have very little out-of-pocket costs at that point. Okay, third and final piece of any requirement is credit. Now, I could do a whole half-hour-long thing on credit, but to shove it down into 60 seconds or less, let's say you need about a 620 or higher score. I know you can do it for less. I know a lot of people have more. I'm just trying to keep it simple, okay? Typically, 620 or higher will get the job done, and the lender has to pull it. There's different scoring models. Your Credit Karma on your phone, your Capital One app, your whatever you're looking at on your phone isn't the same score as what the mortgage credit score is. We have to pull all three bureaus. We go with the middle score. Typically, if that's 620 or higher, there's probably an avenue to get it done, okay? Now, don't rush and pay things off. Don't rush and dispute things. Frankly, don't do much of anything with your credit. Let us pull it. Let us advise you and tell you the best way forward. Sometimes paying off this versus this will get you more boost in your score. Sometimes removing a dispute may lower your score, right? Sometimes you don't have to do anything at all. Just don't sweat it. You've been worried about nothing. So let us guide you on the best way to handle the credit to get the mortgage done. Okay, now that we put all three of those pieces together, here's how much income you have. Here's your down payment. Here's your credit. Those three things say if you're qualified or not, right? And then we do what's called debt to income ratio. The more income you have, the more loan you qualify for, right? These three tell you if you qualify, and then debt to income tells you how much you qualify for. So let us put this all together for you. It is free to get pre-approved. It's free to consult. It's free to come up with a game plan. You definitely want to go in this prepared. You don't want to find a house you love and be like, I want to buy it, but I don't know how. I'm not ready. You're going to scramble to put an offer together. The listing agent's going to call the lender and say, hey, how pre-approved is this buyer? And at that point, we're going to say, hey, they're fully vetted. They've been through underwriting even up front. That's a service we provide. Or I'm going to say, I just talked to them. It's last minute. We haven't verified employment. We haven't done all the proper steps, right? How do you want to be presented to the seller? Get prepared, get pre-approved, totally free of charge. Let me know how I can help. Cheers.